Something is tightening in the plumbing again. And this time, the signal is not coming from headlines. It is coming from dealers. Our strategy focuses on mechanisms, not narratives. And when primary dealers aggressively accumulate collateral while repo usage quietly resurges, we pay attention. Over the past several weeks, dealer holdings of Treasury coupons surged above $400 billion. That is not passive absorption. That is defensive positioning. Dealers load collateral when they anticipate tighter funding conditions ahead, not when liquidity is abundant. At the same time, borrowing at the Federal Reserve repo facility jumped toward $30 billion after weeks of near silence. That combination matters. Repo usage rising while dealers hoard collateral tells us circulation is becoming constrained. And circulation, not sentiment, determines stress. Now layer in what just occurred in private credit. A major private credit manager was forced to sell assets and gate a fund. That is not systemic collapse, but it is consistent with Stage 2 behavior inside a credit unwind. In Stage 1, outflows are offset by new inflows or bank credit lines. In Stage 2, those offsets begin to disappear. Banks step back, liquidity margins shrink, asset sales follow. When private credit stress intersects with tightening collateral conditions, the probability of broader funding friction rises. If you find value in breaking markets down this way, into signals and sequencing rather than noise, consider subscribing. The goal here is not predictions. It is helping you see regime shifts earlier so you can think more clearly when volatility arrives. Our phase assessment remains probability-based. We estimate roughly 65% probability that we remain in late Phase 1 to early Phase 2 conditions through mid-2026. We assign approximately 25% probability that Phase 3 funding stress emerges before year-end 2026. A full forced liquidity Phase 4 cascade remains a lower probability, near 10% in the immediate term. But that probability rises materially if dealer inventories continue expanding, while repo usage remains elevated into the third quarter. What matters now is confirmation versus invalidation. Confirmation would include sustained repo facility usage above prior baselines, continued expansion in dealer treasury inventories, widening high-yield spreads, and deterioration in labor market hiring rates. Invalidation would include repo usage returning to near zero, dealer inventories normalizing lower, credit spreads compressing, and auction demand stabilizing without tail risk. This content is for educational purposes only and reflects a probability framework, not investment advice. The key is sequencing. Markets can ignore stress signals temporarily, but funding stress rarely resolves without either policy response or asset repricing. Our strategy does not predict collapse, it tracks pressure. And pressure, when left unresolved, eventually forces resolution.